Hello, welcome to Cryptonomy. Today we're going to be discussing the looming private credit crisis or crunch. So, the events that are happening right now are reminiscent of the 2008 financial crisis in many ways. But they are not as severe yet. But how, if you go look at the 2008 financial crisis, similar things, cracks start to show under the surface and then things start to just accelerate very quickly. And therefore, I do not usually like to react. I like to be active. I like to anticipate what's going to happen. And that's how we can be better prepared for what's to come, right? The banking crisis could return, it could not. But should we not know the probabilities of it happening, or what's under the hood? What are the signals that could tell us, yeah, we should be more careful? Of course we should. So there have been recently a lot of reports, especially last month, about the recent defaults. There was a lot of talk about the Blue Owl, right? Blue Owl Capital. They're having some trouble. And yeah, these are private firms, but one thing you have to know about these private firms is that they're funded by banks and other major players in the financial industry, insurance and some other private individuals as well. So what I did is I did some deep dive research using ChatGPT and other websites, and I put everything in a document. I highlighted everything that is important. We're gonna just touch on the important stuff to get you the idea that you need, but you're more, more welcome to just pause and along the way and just read maybe the highlights or full up to you. Maybe I'll leave a link to the document in the comment section. All right. So without further ado, what's happening? To start, what started my research is there was high-profile defaults connected to bankruptcies and fraud allegations that were raised to questions about the health of credit markets. Yeah, centered around the rapid growth of the 1.1 trillion U.S. private credit market. So this problem is in the U.S., but it could easily widen, right? So we know that China's having some problems with their real estate as well, and their banking and other European countries. So this is probably gonna, if there's a banking crisis, gonna be worldwide, same as the 2008 financial crisis. And yeah, and after that, there's also another topic that we're gonna research. There's the injection, there's the liquidity that Trump has recently injected in the economy. I think in the 10th of December or something, they injected some capital, and that capital was injected into because of this issue, because of this problem. So it is definitely concerning, and it is definitely not overlooked by regulators. So that's good to see. Before we start, I'm Mo. I'm a computer and data scientist. I've been a crypto investor for the past 6 years, and I turned a small crypto portfolio into 6 figures this cycle. So if you would like to learn some of the things that I do, one of the things I do is actually research. Most of the stuff we put on the channel is a lot of about technical analysis and fundamental, right? But this is more on the fundamental side. Yeah, so if you like it, try watching this video and like and subscribe, please, if you enjoy it. So yeah, that's basically the main point here. But the first thing you can see, this was posted by Goldman Sachs, and they underestimated the figure. So it's not 1.1 trillion. That's the first thing you see. It's actually 1.6 trillion, okay? And it's expected to grow to 3.5 trillion by 2028, okay? And if we see how this private credit started after the 2008 financial crisis, and it has been ever growing, right? Especially after COVID, we started to like seeing the exponential growth, right? In that thing. And right now we're just gonna be doubling and doubling and doubling. Just to know who actually puts money in these private credits. First, of course, these is private firms that lend that money, but in those private firms, this is the people that put the money there. Asset managers and fund managers, insurance companies, there's some others, families, foundations and endowments, and private and public pension funds. A lot of people involved. Banks. Yeah, after 2008, they pulled out lending to risky stuff, and therefore, the private credit took the slack. Just as a little bit to understand what is private credit, these are basically loans that are negotiated privately, and they're given to small and mid-sized companies only. Okay, so not big companies. They are highly leveraged and unable to borrow. These companies, they cannot borrow from public corporate bonds. Okay, that's why these instruments are for them. And the thing is, the interest rates on these loans are actually quite high, so 10 to 13%. So imagine you're a small company and you have a lot of expenses and probably some profits, but you're still unsure, and you know, it's not like big companies that know how much their income is, and you still have to pay 10 to 13% of your profits, you know, for interest. Not of your profits, but you have to pay 10 to 13% of the borrowed amount from your profits or even expenses to these companies. So that's not small. And these percentages go up. They go up in times of uncertainty. They go up when headlines like this start to be on the news, and when these percentages go up, that puts more pressure on small and mid businesses, which make them even more, it's difficult, one, for them to borrow more, and two, for them to repay their loans. And if the small and mid-sized businesses are struggling, guess who takes the hit? They have to fire employees, they have to close their operations. If you fire employees, you get higher unemployment rate. If you get higher unemployment rate, you start to see acceleration in recession fears and maybe even get a recession. So yeah, it is important. It affects the backbone of the economy. And if you can relate it to today's market, you see that most of the companies that are going up are actually the top 5 to 10 companies, and the small companies are struggling in a way, and this just adds to the struggle, right? So we've discussed how much the money they have and how much we're exceeding, but just to put it in perspective, the global banks hold around 190 trillion in assets. Okay, so that's a small fraction of what's being lent out, but that's global banks, by the way, not America. Okay, and if you take the American, it should be much less than that, right? And so it is significant, but it's not overly scary in a way. So yeah, they private credit, they raise funds from investors, pensions, and insurance, and wealthy individuals. Um, why this is why analysts are actually worried, because stress is building up under the hood, and it could trigger a wave of defaults or a pullback in lending. That's what the worrying part. If you start seeing small companies and mid-sized businesses defaulting, then you know more people will be worried for lending such instruments, and then they're going to be harder for them to lend more, and they maybe have to just close their businesses, right? There's one important point actually. Yeah. Before we sell all our stocks or whatever, crypto, these funds are actually locked up for 5 to 10 years. So if you give funds for this private credit, you cannot take out your money for minimum of 5 to 10 years. So you cannot see bank runs as such. But what you can see is defaults. You know, some companies will default on their loans, and that's the scary part. The bank run part is not the scary part. That's long-term scary. Medium to short term, fine. Medium to short term is the risk is the default. So let's continue. Yeah, the private credit, unlike what many people think, it is not isolated, all right, from the banking industry. It is well connected. So they are indirectly involved in various ways. They provide finances to private credit funds. Those are the banks, okay? Yeah, so many analysts believe this will not escalate 2008 systematic crisis, but when you see headlines like this, when JP Morgan starts to make attention, right, and Goldman Sachs, so here's JP Morgan also posting about this thing, and they're saying, don't worry, private credit is still small comparing to the other lending instruments that we have, but that's considerable. Okay, that looks like around the 10 to 20% of this whole thing, maybe more than 10, 15 to 25, 15 to 10, let's say 20, sorry. And they write about why you shouldn't worry. But when when JP Morgan says don't worry, you should worry. When JP Morgan says sell Bitcoin, you buy Bitcoin, right? I mean, who trusts JP Morgan? Yeah, JP Morgan says it's only 9% of all corporate borrowing, so it's around 10%, right? Not large enough to threaten the broader economy. 10% is large enough to threaten the broader economy. It is large enough. JP Morgan don't say that. What? Locked in and cannot pull their money. Yeah, they say sure, but you don't talk about defaults. Like if they are telling you not to worry, that's when I'm starting to get worried. It reduces the risk of a sudden or liquidity crunch. Sure, but yeah. So if private credit portfolios with trouble, the spill might dent a few institutions rather than threaten the entire banking system. JP Morgan. Oh, so you're saying there are gonna be some dents? That's what you're saying? Thank you. Thank you. We're so feeling better now. Yep, that's in that article. You can get it from there. Very, very, I feel very relieved. Okay, a major economic downturn is the scenario that truly worries regulators. Yes. So the biggest risk here is that this will not trigger the recession or the economic depression or whatever we might go through if we go through it, right? Uh, by the way, nothing said in this video is financial advice. It's for education purposes only. This is only for research, so I hope just it helps you, like it helped me, make some of my decisions. And some of the things are going to be clear, and maybe you can formulate if you're thinking you're bullish or bearish or whatever, right? So yeah, the risk here is not that this could trigger the financial recession if there's to be one. The risk here is that it will make it more severe. Okay, so if there are layoffs, and then some companies start to default on these loans, and then there's more layoffs, and then more people don't work, and then just snowballs, right? This is one of the things that will snowball a medium recession to a heavy recession type of thing. Even the IMF has repeatedly warned about the severe recession. We could see defaults and significant losses in private credit. Warned that in a severe recession, see, if there's a severe recession, we will see some bad things happening. Yeah, the concerns are valid, but severity outcomes ranges from contained burn, like what JP Morgan thinks, and a potential wildfire. I am guessing if we go into recession, I'm betting on the wildfire scenario because the economy is not looking good, right? Industry adoption and golden argument. This is not important. The bottom line here is yes, there are serious concerns about private credit, and you should keep them on your radar. But many experts do not envision an abrupt implosion absent broader economy downturn. It's more likely to be a slow burn of rising defaults and lower returns, unless the economy really turns south, in which case all bets are off. So the same song is being sung, right? It's going to be a slow burn, rising defaults, low returns. Unless the economy goes into recession, then we're all doomed. This is a critical point. Private credit doesn't exist in a vacuum. Yeah, a lot of players lend money and take money from this. It's not a separate entity. We just don't know who's going to go down, basically. It's a lot of people put money into this, right? The kind of tightening in financial condition is one mechanism by which credit crunch can drag on the broader economy. Less credit flowing means less investments and more pressure on marginal firms. Impact on equities, right? This is for stocks. Equities, especially in sectors like small cap companies or industries with heavy debt, could sell off. Reasonable. I think the small cap is going to be first because these are the people that borrow, and then we just go up from there. Yeah, a reflection of tighter credit, obviously less liquidity and higher yields. You don't want to borrow as much if the yield is high, are generally bearish for stocks. And just to give you an illustration of how this is the blowout, we'll come back to that. Give you an illustration of the percent that is given to Blue Owl is around 12%, 11.95. So this is the yield they get from what they lend. And Blue Owl capital is currently in the center of the market anxiety over private credit, with recent events sparking concerns about liquidity, asset valuation, and broader systematic risk. The company is facing scrutiny, but has not triggered general credit crunch in a wider market yet, right? So one of the things that they're actually taking some legal action against them. Um, where was it? For investors have been announced. Allegation of Blue Owl failed to disclose pressure on its asset base from redemption and related liquidity issue between February and November 2025. So there's some legal action against them right now as well. And their stock declined, and there are redemption restrictions. Blue Owl temporarily blocked redemptions from non-traded funds. Amazing. Yeah, it doesn't sound like it's a bad thing, right? Oh, it looks so dark here. That's fine. Liquidity concept, because when I have the white, it's like that. See, a boarded fund manager in November 25, Blue Owl terminated a planned merger between two of his private credit funds, Blue Owl Capital, and so there's trouble. Especially it's one of the most well-known private credit providers there. So right now you can see the mood is risk off. It comes in time for the stock market starting to decline, and you can see that Bitcoin is sensing some economic turbulence, and therefore this adds to the narrative that people do not want to be in risky assets like crypto and other things. That's the mood, and that fits the narrative right now that we're going through. So I wouldn't be surprised to see this come up later in a month or 2 or 3, or sometime by the end of the bear market, where we get that FTX type collapse. Right? That's when the bear market ended it. FTX collapsed. We saw the previous one. We saw the first brands that even mid-sized Wall Street firm, Jefferies is also connected to Blue Owl, by the way. I think it's significant write-downs, and nation's largest bank, JP Morgan, was, see, they come up. That's why they post JP Morgan. Don't worry, guys, because they're involved. Wasn't unscattered either. Flosses' private loans mount, certain banks or finance companies could report hits to earnings or capital. This is the psychological effect of shadow bank. Yeah, so if some banks have large concentration of their capital in this stuff, then you could see it threaten that, you can threaten the banking stability here. We saw something similar during the 2007 credit crunch. So in 2007, there was a credit crunch, right? And so there's a tail risk scenario. There is. Where private credit woes contribute to financial instability concerns. Yeah. So right now we are seeing safer assets like treasury bonds doing well, and gold also fits the narrative, right? It fits what's happening. I think this has stuff to connect with what's happening right now, and therefore we're seeing some of the things that should play out in situations like that, right? And of course, gold is not going up just because of that, but several reasons, right? For example, fears of a world war, or people losing faith in fiat, and so on, right? People getting off the US dollar and stuff like that. That rushes people to gold. They worry about the lose of private resources are interconnected with wider financial markets. Yeah, we know that. So in the short term, that's what we care about, right? What does it mean for Bitcoin? We're almost at the end here. For Bitcoin, we can see a credit crunch scenario play out, right? It would likely be bearish for Bitcoin and crypto, because Bitcoin basically is liquidity is a factor that affects Bitcoin's price. So if you have a credit crunch, then liquidity, is just going a little bit down, and that factor just negatively affects the BTC price, right? So just an example, Bitcoin plunged 50% in a matter of days as global markets sold off, showing it was not immune to broad liquidity crisis. So, say in other words, there's a financial storm, high volatility, fear in the market. Bitcoin has behaved more like a risky asset that people sell rather than a safe haven they flock to. That's true. Sometimes it is perceived as a safe haven, but that's rarely happening. I think Bitcoin needs to a little bit mature as an asset class. Has matured a lot for the period uh, that it existed, and I'm a huge Bitcoin fan. Yeah, see that. But we still need time. We need to trade the market that we have, not the market we want. You know, Ben Count says that, and I think that's true. We would expect leveraged players in crypto to deleverage, and some investors to reduce exposure into speculative assets. Liquidity matters for Bitcoin. But there's also a crisis catalyst. We can look at the good side too. Bitcoin sometimes experiences short-term spikes during financial crisis due to safe haven narrative. In March 2023, when several US regional banks like Silicon Valley Bank failed, if you guys remember that, see, the banks have been failing. It has been a narrative this whole cycle. All right, at the start of this bull market, we had a lot of fears of banks collapsing, right? But that was positive for us. In the immediate aftermath, Bitcoin price surged over 27%. I remember that. We were like, yeah, let's go. Hit all the banks. Bank run. I love it. Yeah, I love crypto people. Jumping from around 20 to 26K. Not bad. Yeah, that was so good. That was so good. Gold and Bitcoin both rose while S&P fell. That's where we win, guys. If a private credit crunch were to morph into a broader banking crisis, one could imagine Bitcoin catching a bid amid panic as a fraction of investors seek a haven outside the banking sector. I can see that playing out, but that I think we need like a severe market downtrend and crisis for people to be like, yeah, F the dollar, F the bank, F the euro, Bitcoin all the way. Let's do that. Let's do that. Yeah. This dynamic, however, is likely to be relevant only in severe crisis of trust. In most garden variety recessions or risk-off phases, Bitcoin behaves risk-off as well. So it goes down, usually, unless we have that severe crisis of, yeah, let's just underline that, severe crisis of trust. And private credit supports that thesis. It implies tighter financial conditions. Yeah, so this is what we're saying. The narratives right now do fit what's happening right now. We're having private credit, turmoil. It implies tighter financial conditions, potential recession, and a risk aversion. We're not seeing tighter financial conditions. We're seeing kind of QE, all pointing to downside for Bitcoin in the near to medium term, if I understand that correctly. I'm not sure. If a private credit crisis contributes to a recession or serious financial scare, the likely policy response from central banks would be to shift back to monetary easing. We are seeing that. Should we be more worried then? The Federal Reserve would cut interest rates, perhaps aggressively, which we have done, possibly even restart quantitative easing, which we have done, or other liquidity programs if the situation were dire enough. Such responses would be aimed to stabilize credit markets and stimulate the economy. Easy monetary conditions have historically been a boon for Bitcoin. We are seeing stimulation. We are seeing some form of strategies to stabilize credit markets. That's why Trump has, I don't know how much they bought, but some billions, it's in the B's, and they're just gonna do it every week or month or something like that. I'm doing that research soon, so if you want to watch that as well, to continue the story and understand what could be happening in the financial economy and how it affects Bitcoin, then do subscribe and like so that you can actually watch the next one. Bitcoin massive bull run 2000 coincided with periods of extreme low interest rates and ample liquidity. Yep, and that's why this cycle we haven't seen that crazy price movement because, well, financial conditions, interest rates were high, quantitative tightening and all the stuff, but we still went up 700% from the bottom. All right, we did so good. That was so good. People think this cycle was bad, but it was so good. We went from 16K to 120 something K, 24. That was good, guys. That was good. If you think that was not good, then you need to come earlier next cycle, which means you have to watch videos like this. So that in the bear market, you know how to catch the bottom. Like we will. Like we did. Alright? This cycle was not boring. It was so exciting. It was so nice. Just need to be early. I need to understand, look ahead, not look one forward too, ahead and forward. Not now. Now is irrelevant. You have to study history and speculate on the future. Now is irrelevant unless you're placing a trade, which I wouldn't suggest without prior planning or future speculating. You get the meaning. Bottom line, yes, let's go to the bottom line. In the context of expected bear markets through next October, our thesis is that bear market to next October. Private credit caution where stands for BTC in the short to midterm. Yeah, obviously. Any rallies could be short-lived unless triggered by a major policy reversal or narrative shift. This why always be looking forward to such events, because right now for example, I am biased to the downside, but anything could change that through some policy or some narrative that just could change everything. Validity of concern. Yeah, let's jump to the conclusion finally. There are clear signs of strain. Many borrowers cover interest rates, default inching up, some loan blowups, and regulators openly worried. It's a real risk factor, though not a guarantee to trigger full meltdown unless the economy really soars. The system has some buffers, locked in capital, 5 to 10 years, relatively small scale. So it might be more of a grinding problem than an acute crisis, but it's definitely something that could amplify a downturn. Credit crunch would likely go hand in hand with a general credit tightening or risk of environment. Since it increases, sure, they can be an early warning to trouble that will affect all markets, Bitcoin included. Right now, they reinforce a cautious outlook. Summary: this will not trigger a recession, but if a recession happens, it will make it more severe. It's important to understand that this is happening to get a cautious perception of the situation and not just overlook the whole thing. But nothing to be very worried about. I think the regulators have got it. We're just going to kick the can down the road and they're going to just pump the printer, and I think we're going to be fine. If you enjoy this content, please do like and subscribe. I'll bring the next piece of research very soon. See you guys.